Hi, and welcome to the Stockscores Market Minutes for October 31st, 2014. This week, the spooky fears that traders must avoid. Before I get into that, I want to talk about our upcoming events in the month of November. I will be doing live presentations. These are free to attend in Toronto, Ottawa, Montreal, Edmonton, Calgary, Vancouver, and Surrey. Now, many of you are not in those cities. We have viewers of this video all over the world. So for them, I will also be doing a webinar on November 25th. You can get all the details at stockscores.com/tour, or simply go to the Stockscores homepage and click on the blue button in the upper right-hand area of the page. All right, let's talk about the spooky fears that traders must avoid. The first is FOMO, the fear of missing out. We will often take marginal trades because we worry, we are scared that if we don't take a trade that looks pretty good, we will miss out on a big profit. The result is that by taking marginal trades, we lower our probability of success and our overall profitability. We actually tend to make more money by trading less. As long as you have a high standard and you take those trades that fit the rules of your well-tested and proven strategies, you can do better. So don't have that fear of missing out. The second is the fear of losing money. We all have an emotional attachment to money, and as a result, we tend to make undisciplined mistakes when that fear of losing our hard-earned capital comes into our mind. Now, both of these mistakes cause us to make bad trading decisions. There's two ways to remove our fear. The first, and this pertains mostly to the fear of losing money, is to lower our risk. You should be comfortable with the amount of risk that you take on any one trade. If you can't sleep well at night, then you have taken on too much risk. If you are nervous when you are in a trade, you have taken on too much risk. The best traders are those that don't care about the money, and the less risk you take, the less you will care. The second thing is having confidence in your plan, and this assumes that you have a plan. You must have a written trading plan for when to buy, when to sell, how to manage risk, and how to manage emotions. If you don't have those things, you won't do well in the market. But you also must have confidence in your plan. If you have not tested your rules, then you will not have the discipline and the confidence to follow them. Even if you're trading my rules, if you're one of my students and you are trading one of the strategies I have developed, you need to put in that time to test that strategy and have confidence in that plan. So make sure that you avoid FOMO and FOAM. If not, you will make mistakes in trading. All right, great week for the market. We move back to the old highs of early September, and that means there is no risk of a falling top, which is something I have been talking about in recent weeks. We have taken the falling top out of the question. We are now at resistance where I expect that the buyers will take some profit and the sellers, the sellers will take profits. The buyers will maybe lose a little bit of their motivation given that we've risen up to the highs. I think we could probably go sideways here for a little bit. However, we are going into the strongest 6 months of the stock market historically, and so I think the long-term upward trend continues. Just don't be surprised if we see a short-term pause. The small caps have really been making a good comeback of late. They haven't come back to the highs like the S&P has, but they also fell a lot farther. So we're starting to really see strength come back to the small cap stocks, particularly the biotechs, which got pretty beat up in through October and September. And we're seeing that comeback happen, and that sets us up well for the November to May period. Now, I have found that a lot of the charts of stocks that I look at on a daily basis, had pretty ugly charts, and they are now fixing themselves. So we're not seeing a lot of individual stocks start to show good charts yet. We're mostly seeing things repairing damage from the correction, but we are starting to build optimism. We're starting to build stability, and that should again set us up for a good run into the end of the year. TSX 60 is really lagging the recovery of the S&P and the all the US markets, and that's primarily because of the heavy emphasis in Canada on the mining and energy sectors. And of course, with the strong US dollar, with the big supply of oil in the world, energy stocks have really been beat up in Canada, and so have the miners. Gold breaking down, we'll talk about that in a moment. So we're seeing a recovery in the banks and some of the sectors that were leading before the correction, But the sectors that started to weaken long before the correction are still relatively weak. And we'll talk about those a little bit more detail in a moment. TSX Venture heavily emphasizing the commodity stocks and really looks pretty ugly here. It is at some support and it tried to hold that support on Friday, but I think until this market builds a rising bottom and breaks from a rising bottom in general, you want to avoid this market. Now, there are some biotech stocks on the TSX Venture. There's always going to be that one or two stocks that can just outperform everything because they discover something big. You know, if you're a miner and you discover a big mine, it doesn't matter what the price of the commodity is, you've garnered some value. So those are things to keep in mind, but generally on the TSX, the investors are not interested, and it really takes big, significant fundamental change to drive interest on that market. All right, the US 20-year Treasury bond continues to be in that upward sloping channel. It hit the top of that channel 3 weeks ago and has pulled back since. I think we could see a little bit more of a pullback, which would mean a short-term rise in interest rates, but we're talking a relatively small raise in rates over the next couple of weeks. We get down to the bottom of the channel where we should bounce, and we'll have to see if this upward trend in treasuries continues, which of course means a downward trend in interest rates. For now, I think longer term, I remain bullish. Short term, wouldn't be surprised if we see a little bit of a drop in treasuries. US dollar really had some strength on Friday after Japan announced whatever they want to call it, quantitative easing in Japanese style, and that caused the US dollar to spike higher, the yen really drop. And so the US dollar is back to that resistance level. Now remember, what we look at when we look at the UUP is a basket of currencies against the US dollar. It's the yen, the euro, all kinds of different currencies. So in general, the US dollar is the strongest currency around, but it is at that long-term resistance where it should stall. But I think in general, you have to call this a bullish chart, threatening a breakout through some real long-term resistance, which would be negative for commodity prices. And you can see the effect it had on the price of gold, moving to new lows from falling tops. We've been pretty bearish on gold for some time. I had thought that it might hold support a little bit longer, but it has failed to hold support. And so therefore we have to say that gold looks more likely to go lower than higher. Oil has fallen to support. It did that 3 weeks ago and bounced. It's done it again this week and trying to bounce. It's heavily oversold. Look at the distance between the red downward trend line and where prices are. That means that although this is a very bearish chart, the price of oil is due just for some kind of a bounce back. There's no real sign that it's going to bounce back. There's no break from a rising bottom on a real short-term chart, you know, an intraday chart, let's say, of oil prices, but it is due for that. So although I'm bearish on oil long term, I have to think that there will be some kind of a bounce back short term, and that is a tradable rally for the day and swing traders out there. It's not something that you want to take advantage of if you're looking at your portfolio once a week. In general, right now, I would avoid oil stocks, but if you're a trader, you might play that bounce that has a good chance of happening in the next week or two. All right, the VIX has been coming back. I've been trading the VIX pretty heavily through the month of October. Made nice returns on that. I think the party there is just about over. The VIX is almost back down to support. I think it can fall a little farther, get down to that green line perhaps. But certainly it's showing that fear is coming out of the market, and that makes sense given that the S&P has moved back to new highs. Now it is worth noting, however, that while the S&P is back to new highs, this is not back to new lows. So people are still buying some insurance. There's still a sense of cautiousness out there in the market, even though the market has recovered well. So U.S. stocks, I'm neutral long term. I think that we're going to stall at the long-term resistance level, but bullish short term. I mean, you can't argue with the trend short term. I think that we stall and see some profit taking after the last few weeks of strength. Canadian stocks, you know, I've put a neutral rating on it. It's still got more recovery to go, but it's not all sectors in Canada. You have to be pretty selective. You know, the commodity-related sectors are having a tough time with commodity prices, and we're seeing, you know, some economic numbers come out of Canada which show that the economy is not doing so well, and that makes sense given the strength of the U.S. dollar. So I think you got to be a little bit more cautious with Canadian stocks. Be picky in which ones you trade. Gold, bearish on both time frames. That breakthrough long-term support is an important one. Oil, neutral long-term. I think simply we're at that point where it should bounce, but it's still bearish short-term. We haven't got any sign of optimism building in the short term, so I don't want you to jump into that oil trade with both feet. But if you are a trader, watch for those signs that oil is going to make a little snapback rally and take it back to the downward trend line. The U.S. markets have come back to their old highs, escaping the falling top, which is great. Canadian markets lag, but are still recovering. Gold has broken long-term support. Oil is at long-term support, which it needs to hold. Still very oversold and due for a bounce back. Start to trade individual stocks. The market will matter less. So evolve away from trading the volatility in the market and get back to trading individual stocks, trading on their own story. Well, that has been the Stockscores Market Minutes for October 31st, 2014. Have a great week in the market and trade well.